Ladies and gentlemen, welcome back to another round of Cash Flow Positive, the podcast where real estate investors learn how to maximize their revenue and dominate the rental game. In this corner, wearing the crown of flexibility, higher nightly rates, and Instagrammable vibes, it's the heavyweight cash flow champ, the short-term rental. Ding, 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 ding. And in the other corner, with steady and low maintenance, packing month-long bookings and even travel nurse loyalty, it's the up-and-comer, the midterm rental. Okay, I just wanted to do that for fun. Welcome to another episode of Cash Flow Positive. I'm your host, Kenny Bedwell, and today we're doing the boxing match between midterm rentals and STRs, or short-term rentals. So I've been dying to do this for some time because a lot of people with shifts in the market, people are looking to change out of short-term rentals and they look at midterm rentals as an option to move into. So what I wanted to do for this week's series, hopefully this was really fun and exciting and you were like, what the heck is going on? I am bringing in a midterm rental expert on the next episode, the part 2. And she's going to lay out all the pros and some of the cons of doing a midterm rental. I just interview her. I'm not a midterm rental expert. I don't want to slander it. I have my, my opinions and views on it. But I'm going to tell you why in this episode, I am still really bullish on short-term rentals. And she's going to tell you why she's really bullish on midterm rentals. And you can, at the end, decide for yourself what makes sense for you to personally do. Let's hop into today's show. So, short-term rentals. First off, as I kind of mentioned in my, let me know how that intro was. If you like that intro, send me a message or something that's like, Kenny, you should do more of those. Or Kenny, don't do those. So anyway, let's talk about short-term rentals. So I really like short-term rentals, obviously for the cash flow. I think short-term rentals have some of the highest upside and potential out of any type of real estate investment class. And that's been proven. That's not, that's my opinion. That's just a simple fact. Short-term rentals make more money than long-term rentals and midterm rentals. However, I would say caution that is you have to know what you're doing and you have to be willing to invest into the property. So although short-term rentals can make more money, 2, 3 plus X, even more than a midterm rental or long-term rental. If you're not willing to invest in the property and you don't buy in the right location or buy the right it's just buy the right property, right? You're not going to do those numbers because short-term rental is very subjective. So one of the reasons why I think it's a great asset class to enter into is because the margin of error is actually fairly low with short-term rentals compared to other types of real estate. The margin for error, believe it or not, even with long-term rentals, although you know what the purchase price is and you know what rents are in the area, you're maybe cash flowing a few $100s if you're lucky a month, right? So what happens, and you never hear these things with long-term rental investors, they never talk about this, which are capital expenditures when things break inevitably in the property. When tenants, destroy your property or don't take care of things or, let things that could have been fixed immediately happen the property just deteriorates and you have to replace yourself. And the measly $200, $300, $500 you got per month is quickly drained because of the expenses, the capital expenditures. And so for me personally, if you're looking for cash flow, a long-term rental, or we could even argue a midterm rental for that point, isn't really the best play. Now, is this all long-term rentals, all midterm rentals? No. Okay. But midterm rentals give you some cash flow, but it's more about an appreciation play over time. And so that's why I really like short-term rentals, because cash is king and you can really, really cash flow with a good short-term rental property. The ROI, you should cash flow more with a short-term rental property than a midterm rental. However, consistency is a problem. What I mean by consistency is basically occupancy. Occupancy goes up during some months of the year and down during other months of the year. And so with short-term rentals, you're going to have higher. So your budgeting system has to change. That's challenging for a lot of people because a lot of people want to think like every month is the exact same. Like our bills, our mortgage is the same amount every single month. Our car payments, loan payments, whatever payments for the most part are relatively the same. Okay. However, short-term rentals are like credit cards, right? Certain months of the year, our credit card debt is a little bit higher than other months of the year. Now, if you're the person that's like, well, I pay off my credit card every month. Great. That's not what I'm talking about. I'm talking about the amount, right? Christmas season, shopping season, credit card bills are a little bit higher than others. Short-term rental revenue during certain seasons is a little bit higher than others. And so you budget slightly differently throughout the year. It's the same thing. Like, okay, I'm saving for Christmas time or that vacation that we're going to take in, 6 months or a year. And we're going to budget for that. It's the same kind of mentality you have to have with short-term rentals, which is completely different. Does it mean you shouldn't invest in short-term rentals? No, it just means you have to think differently. And I think that's the main difference, in my opinion, between short-term rentals and midterm rentals is the ability to think differently. A few years ago, you could throw anything up on Airbnb, it would make money. We know that is not true today. Hopefully you know that today. If you've been listening to the podcast, you know that's not true. So if that's the case, then we have to think differently and we have to think about what we're trying to sell. And you have two different products with short-term rentals and midterm rentals. Short-term rentals are more focused on selling an experience rather than just simply a place to stay. And with midterm rentals, we'll learn more about that with our midterm rental expert that you're going to hear on Thursday. Hopefully the episode comes out on Thursday. It better come out on Thursday. I recorded this like weeks in advance. So anyway, but the experience with short-term rental, you're selling an experience, whereas midterm rentals, you're selling a place to stay that's convenient for a traveling worker. It doesn't have to just be nurses. It can be businessmen or, families, insurance placements, things like that, or displacement, excuse me. But with short-term rentals, you are selling an experience. In my opinion, that's more exciting. And obviously it's more lucrative because if you can sell the experience correctly, you can make a lot of money and have a really high return and inevitably potentially sell that as a business to make even further capital. And so that's why I really like short-term rental opportunities because number one, I think we're still in the early stages of short-term rentals, meaning like banks still don't recognize it as a true asset class yet. However, we have seen an evolution, of the short-term rental asset class. At first, like 5 years ago, you really couldn't get a loan that was for short-term rentals as a short-term rental. Now you can get debt service coverage ratio loans. I'm only going to say that one time. The rest of the time, I'm going to say DSCR because that's the acronym for it. DSCR loans, commercial loans, essentially for short-term rentals based on short-term rental revenue. Okay, now that doesn't necessarily mean it appraises purely based on short-term rental revenue, but having that revenue can help the appraisal and can help the debt service where you don't have to base it off of your debt to income ratio. That wasn't available 5 years ago. So the industry is maturing and banks are starting to recognize that. If you can recognize the evolution of it, you'll realize we're still really, really early. And it's only a matter of time. Okay, let me say that again. It's only a matter of time before there are loans purely based off revenue and maybe even revenue potential. That one is debatable. We shall see on that one, but definitely revenue of the purchase price. Meaning if a property in the market as a residential home is sold for, $500,000, but the property generates, we'll call it, $100,000. The cap rate is 10%, and cap rate, look at NOI and other things, and they could sell a property for $750 or $800 or $900 regardless of the appraised residential value, which is how it works today. So today, if there's a $500,000 home, it makes $100,000, and the appraiser says, hey, look, all the other residential homes in the area are $500,000. Guess what you're going to have to sell it for? $500,000, unless you have a cash buyer that really wants to, pay extra for it. And that's actually going on too right now. There are people we've had a client do that. They bought a property in a vacation rental market on a national park, in a market where the number of permits were capped for short-term rentals at 30, and they paid $200,000 over asking. They paid the gap for what it appraised for because that property is purely an investment property and they're grandfathered in with all the rules and the supply is capped. It's a vacation market and it actually makes sense for what they paid for it. But because it's purely an investment play. So as people start to do this and as banks catch on and this starts to really evolve, we're going to find a tremendous opportunity, especially for those of us with really cool properties that have the amenities and are, top 10% in a market, top 1% even. We're going to be able to basically appraise and refi out of, or well, I guess you can keep your property if you refi, but you know what I mean? Like take the capital and just get an insane amount of appreciation, even though the market might not have appreciated from a residential real estate perspective. I think that's really exciting to think about. So if you can focus on building a brand and building a portfolio that has a brand and an image, you might one day have a commercial, property, like for example, Marriott Homes come through and want to buy out all of your properties. Okay. They're not going to buy it based on residential real estate. They're going to buy it based on how the revenue is performing. Right. So that gives you a cap rate. And now you're trading on a cap rate rather than residential real estate. I love that about the potential and the future for short-term rentals. That will happen. And we're seeing instances of that happening around the country where people are buying portfolios of short-term rentals in specific markets. Now, it's still, not super common, but the fact that that is happening is a really good sign. That means that there could be some massive appreciation regardless of where the real estate market currently is, because it's the transformation of people, the banks really, turning short-term rentals, looking at short-term rentals from an eye of like, it's a side gig to this is a long-term investment. This is a business, which we know it is a business, but we need the banks to catch up on that. So that's big news. You don't have that potential, in my opinion, with midterm rentals. And even if you did, remember the rents are a little bit lower, so you're not going to get as much as that. So midterm rentals are more like one-off plays in different markets where you can, host people who are looking for those, shorter stays and not looking to rent for a full year. I think that, in my opinion, I like the upside higher with short-term rentals in the long-term perspective. Yes, they're getting more competitive. Yes, in certain markets, you have the amenities arm race that I've talked about before. But if you buy right, the right location or the right moat, which we talk about a lot, okay, you buy those things, you're buying in my opinion, think about the future, you're buying a commercial asset. You're buying something that I believe will appraise much higher than what it is today. And now, you might say, well, how long is that? 5, 10 years maybe, but I'd be shocked if it goes beyond 10. So, and that's really not that far away. So I think there's tremendous upside with short-term rentals from that perspective, besides the fact that they could just make more money than midterm rentals. I think the other thing too to think about with short-term rentals that people forget is that because you're selling an experience, it's a really cool opportunity to own something that you can be proud of. I'm not saying you can't be proud of a long-term rental or a midterm rental, but how often do you hear me talk about my long-term rentals in Buffalo? Did you know I had long-term rentals in Buffalo? I don't talk about them because they are what they are, right? Like my long-term rentals in Buffalo actually cash flow a lot because of when I bought, how I bought, what I did to them. They were actually short-term rentals at one point. And so they're like upgraded to the max. So I can charge a premium rate, but I don't talk about them because it's just not like that, in my opinion, sexy and cool. And frankly, like I don't really care. Now I care what happens to them and everything, but it's more for me, it's more of like the appreciation play and the long-term benefit. I cash flow like about $1,200 to $1,300 a month on one of the long-term rentals. And that's great for a long-term rental. But at the end of the day, like, am I going to get rich off these? No, I have to focus on quantity if I wanted to make a ton of money from long-term rentals. And I really don't it's a really hard path to go down. That's a time-consuming path. It's like trying to build a 401k, and wait and retire at 65 when you have all these like diseases and conditions and you can't. Like you can't really enjoy traveling or whatever you wanted to do at 65 because you waited so long. Now, I'm not saying don't invest your 401k. I do have 401ks, but that's not my only investment. And that's like the last bucket I put money into because I can make money faster, cash flow faster, and gain appreciation through real estate, through particularly short-term rentals and commercial assets as well. So what I want, like, you don't see me pulling the trigger. Now, like I said, I don't have a problem with midterm rentals. And in fact, I would rather have a midterm rental than a long-term rental because I'm so comfortable with short-term rentals. But at the end of the day, long-term rentals I'm really comfortable with having some passive income on top of the active income. So last thing I want to talk about, short-term rentals do get better tax savings than midterm rentals. Now, there are strategies out there, which our mystery expert, it's really fun interview. You've got to check out the part 2. Trust me, you will. Like, it starts out with a bang. You don't want to miss it. But there are, hybrid models where you can midterm rent, short-term rent. I think that's great, but you cap your potential from a tax saving standpoint and also revenue standpoint if you midterm rent. I don't have problems with that, but just keep in mind, like, if you're going for high ROI and you're going for high cash flow, you really want to make top dollar, then it's short-term rentals all the way. Go in or don't, like, get in. Don't get in the game. Like, it just, like, and when I say don't get in the game, I mean, like, don't do a 50% job on a short-term rental. It's either like midterm rent it, go in with a strategy to midterm rent, or go all in on the short-term rental. And that's the important lesson, is if you're going to short-term rent, you have to go all in. You have to invest in the property. You have to have the moat and really market the moat. You cannot just 50% it, right? You've got to go all in. If you don't have the funds to go on, look, I get it. I was there once. You're probably going to have to midterm rent or do a long-term rental until you get the funds to be able to do a short-term rental. So I love short-term rentals from the experience standpoint, and not my experience, but selling an experience and marketing the experience and doing hospitality and all of that. Other people won't enjoy that. So it's just not a good fit for them. And I think you have to look at, like, both of those things. Like, how do I see myself, what do I see myself doing? But I personally believe if you're really looking to scale, especially getting into commercial property, and I mean multi-million dollar properties, I think short-term rentals is a really good stepping stone. What I mean by that is, I think that, if you think about it, going from long-term to like commercial properties is a big leap. And not just like, oh, I'm just, renting out spaces to businesses, for long-term leases for commercial. But I mean, literally, like, going to like hotels or, other types of like big buildings where you rent out a ton of, spaces to other businesses. I mean, like, big stuff, multi-million dollar projects. I think short-term rentals on the hospitality side is a good place to get your feet work with single family homes, learn the ins and outs of hospitality and understanding like automation and software and technology and the active side to help you get a base for when you do take on the commercial side. So it's a good like stepping stone. Midterm rentals, I don't feel like you get quite as good of the benefit there, the learning lessons and the software and the operations and the day-to-day that you would get with a short-term rental. Once again, it's not saying you can't learn anything from midterm rentals. It's more so of like, where are you trying to, like, what are you trying to accomplish? If you want to buy a hotel, you need to own a short-term rental before you go down that route. In my opinion, you need to do that. That will help you tremendously because hotels are getting crushed by short-term rentals, right? Like Marriott's and the Hiltons and so on. It's crazy. If you've ever been to one recently, obviously they've like remodeled all of them since COVID, but they've started to add more like, amenities that we had in Airbnbs like 5 years ago. Like I was in a Hilton the other day and they had like more coffee options and they give you water and just like better service and just things that, like, I don't know, I felt like wasn't there years ago. And it's because they have to compete with, they're competing with Airbnbs now. Right. And so if you already understand what it takes to be a successful, short-term rental host or Airbnb host, you're going to be able to take advantage of that in the hotel space because you'll be that much further along than some of these hotel operators because they think old school style. So anyway, I at the end of the day, I love short-term rentals, and I recommend, if you want to be, if you have the time to be, I mean, you can always property manage, but you better find a good deal. If you have the time, or you're okay with a property manager, but you want to sell an experience, you want to have something cool, maybe even to brag about, to show off to your friends and family, but also a place that makes really good money, short-term rentals all day long. That's my argument. I hope you enjoyed this episode. I would strongly encourage you to listen to the part 2. In fact, I'm requiring you to listen to the part 2. So show up for the part 2 episode, hear the viewpoint of the midterm rental expert and what she has to say. And maybe you'll learn something. Maybe you'll be like, Kenny, she knocked it out of the park and, KO'd you or KO'd your argument, or I don't know. Okay, I'm done with the boxing analogies. But anyway, I hope you enjoyed this episode, and I will definitely see you on the next episode of Cash Flow Positive.